Do you know that people have built six-figure passive income businesses with little more than a laptop and internet connection? Stick around and learn how you too could make a six-figure passive income. A surefire method is real estate investing. Sounds pretty exciting, right? Simply put, it's the process of buying properties to make money. You can earn money in two main ways: by renting them out for a steady cash flow, or by selling them later for a higher price. There's also the option of getting into short-term rentals through platforms like Airbnb. Whether it's a cozy house, a sleek apartment, or even a commercial office, real estate offers multiple paths to earning passive income. One of the best parts of owning rental properties is the steady cash flow. You get a regular income from rent every month. That means more cash in your pocket to cover living expenses. Invest in more properties, or build up your savings for the future. Real estate is also a long-term game. Over time, your property could increase in value. This means if you decide to sell it later, you might walk away with a nice profit. Another perk: tax benefits. As a property owner, you can deduct things like repair costs or even claim depreciation on your property. This helps lower your tax bill, which means more money in your pocket. Here are a couple of examples of how you can make money in real estate. Buy a house in a popular vacation spot, like a beach town or ski resort, and rent it out to travelers. During peak seasons, this can bring in higher rental income. Plus, platforms like Airbnb make it easy to manage bookings and attract guests from all over. Or consider buying a multi-family home, like a building with several apartments. You can rent each unit to different tenants, which increases your overall rental income. To get the most out of your investment, here are some tips for maximum benefit. Location is everything. Choose areas where people want to live or work. Whether it's close to good schools, job hubs, or major attractions, a prime location makes it easier to find tenants and ensures that your investment stays profitable. Let's face it, dealing with tenants and maintenance can be time-consuming. If you don't want the stress of handling everything yourself, consider hiring a property manager. They take care of the day-to-day tasks, so you can sit back and relax. But like any investment, there are things to avoid. First, be careful with debt. Don't borrow too much money to buy a property. If your rental income doesn't cover your mortgage payments, you could end up losing money. And don't forget about maintenance. Properties need regular upkeep, like fixing leaks or repainting. Ignoring these small repairs can lead to bigger and much more expensive issues down the line, which can lower the property's value. Have you ever thought about owning a business but felt overwhelmed by the idea of starting from scratch? What if you could skip all the startup headaches and jump straight into earning passive income? Well, buying a small running business might be the perfect solution for you. Buying a small established business means you're purchasing something that's already up and running. We're talking about businesses like laundromats, vending machine operations, a small cafe, or even an online store. The best part? You don't have to build a customer base or reputation from the ground up. The work's already been done, and you can start making money right away. When you buy an existing business, you get cash flow right away. The business is already operating, so you won't have to wait for customers to find you. From day one, you're in the money. Starting a new business is a gamble, but buying an existing one means you already know it's making money, has a customer base, and has been tested in the market. That's a big win when it comes to reducing risk. Imagine owning a car wash. Whether it's automatic or self-service, it's a business people always need. Cars get dirty, and your car wash will be there to clean them. Buy a local cafe that already has regular customers. A little freshening up could make this business more profitable, and you'll have a loyal base to start with. If you're tech-savvy, buying an online store, whether it's a dropshipping business or a small retail store on platforms like Etsy or Amazon, could be your ticket to passive income. You can run it from anywhere. Now, before you get too excited and dive in, here are a few tips for maximum benefit when buying a business. Always check the business's financial records, customer reviews, and operational processes. You need to make sure the business is profitable and has room to grow. If you love food and hospitality, a cafe might be the perfect match. But if you're into technology, maybe an e-commerce store is a better fit. Buy what you understand and enjoy. Of course, not all businesses are created equal. Every business has hidden costs, like unpaid debts, maintenance issues, or legal troubles. Always dig deep and know exactly what you're getting into before signing anything. Just because a business is running doesn't mean it's effortless. You'll still need to stay involved, whether it's managing employees, making decisions, or keeping everything running smoothly. Don't expect to just sit back and relax. By purchasing a small running business, you're stepping into an opportunity to earn passive income right away while avoiding the typical startup challenges. With the right research and involvement, you can turn a solid business into a long-term, profitable venture. Renting out cars can also be an exciting and profitable way to earn passive income. Essentially, you're allowing people to rent your vehicle for short-term use, and you can do this through platforms like Turo or even work with traditional car rental agencies. If you have a car that's not being used often, renting it out can help you make money from an asset that would otherwise just be sitting there. There's always a high demand for rental car. Think about it, people travel for vacations, business trips, or even just need a car for a temporary period while theirs is being repaired. This creates a constant market for rental cars, so once you get started, you can rely on regular bookings, especially in areas with high tourism or business activity. Plus, it's a low-effort way to earn income when your car would just be parked at home. If you're looking to rent out your own car, platforms like Turo make it incredibly easy. You can list your vehicle on their website or app, and travelers or locals can rent it directly from you. You'll make money whenever the car isn't in use, turning idle time into cash. The beauty of this system is that it's peer-to-peer, meaning you have direct control over your listings and pricing. It's your car, your rules. Now, if you're lucky enough to own a luxury or high-end vehicle, you can take advantage of premium rental. Think sports cars, luxuries UVs, or electric vehicle. These types of cars tend to attract customers who are willing to pay a premium for a unique experience. Renting out a high-end car could bring in more money per rental, which is great for maximizing your profits. One of the keys to success in the car rental business is choosing the right car models. Cars that are in high demand, such as mid-range sedans or compact SUVs, tend to get rented out more often. They appeal to a wide range of customers because they are practical and affordable. By investing in vehicles that people are actively searching for, you increase your chances of consistent rentals and higher earnings. It's also important to keep your vehicles in tip-top shape. Regular maintenance, cleaning, and keeping your cars well-serviced will not only ensure that they run smoothly, but will also leave a positive impression on customers. When you provide a high-quality rental experience, you'll get great reviews, which will help you attract even more bookings. However, there are a few things to be cautious about. First, make sure you're covered when it comes to insurance. Many car rental platforms like Turo offer insurance plans, but it's important to check that your personal car insurance policy covers rentals, or you may need to purchase additional coverage. Without the right insurance, you could face serious financial losses in case of an accident or damage to the vehicle. Another consideration is the wear and tear that comes with renting out your car frequently. While you're earning money, your car is being used a lot more than usual, which can lead to extra maintenance costs. This is why it's important to set aside money for repairs, cleaning, and any unexpected issues that might pop up. Most car rental platforms will charge a service fee, which is usually a percentage of the rental price. These fees can add up, so it's essential to factor them into your pricing to ensure you're still making a good profit. The goal is to strike a balance where you're offering competitive prices while accounting for these fees and the costs of maintaining your vehicle. Finally, there's always the risk of damage or theft when renting out a car. Even with insurance, the possibility of your car being damaged or stolen is a reality. To minimize this risk, it's a good idea to thoroughly inspect your car before and after each rental. Make sure the renter is responsible, and consider setting up contracts or taking photos of the car's condition to avoid disputes later on. In the end, a car rental business can be an excellent way to earn passive income, but it does require attention to detail. By choosing the right vehicles, maintaining them properly, and being aware of potential risks, you can turn your car into a steady stream of passive income. You can also earn a passive income using dividend stocks. Dividend stocks are shares of companies that pay part of their profits back to shareholders, usually in the form of regular dividend payments. These dividends can provide a steady income stream, which is especially useful for people looking for cash flow without the need to sell their investments. Dividend payments typically happen on a quarterly or annual basis, so you know exactly when to expect those payments. One of the major advantages of investing in dividend stocks is the opportunity for both steady income and capital growth. In addition to receiving regular dividend payouts, the stock price itself may also increase over time. This means you could benefit from both the income generated through dividends and the potential for your investment to grow in value. A popular way to invest in dividend stocks is through exchange-traded funds, or ETF, for example, The Untitled Chapter U.S. Dividend Equity ETF focuses on high-quality U.S. companies that consistently pay dividends, making it a solid choice for those looking for regular income. Another option is the Vanguard High Dividend Yield ETF, which includes companies known for their high dividend yields. Both of these ETFs offer a way to earn steady income while also providing long-term growth potential. To maximize the benefits of dividend stocks, one effective strategy is to reinvest the dividends you receive. By purchasing more shares of the stock with your dividend payments, you can take advantage of compounding. Over time, this can significantly increase the number of shares you own and, in turn, the amount of dividends you earn. Another key tip is to diversify your portfolio. Don't concentrate all your money into one stock or sector. By spreading your investments across different industries, like technology, healthcare, and consumer goods, you reduce the risk of losing money if one sector underperforms. However, there are some precautions to keep in mind when investing in dividend stocks. First, don't chase high yields. A high dividend yield can be tempting, but it may also signal that the company is struggling or that the dividend is not sustainable. It's essential to look at the company's overall financial health and its history of paying dividends before investing. Also, be prepared for market volatility. Stock prices can fluctuate, and dividend stocks are not immune to market swings. While a company may continue paying dividends, its stock price could go up or down, so it's important to be ready for these changes. Another risk to be aware of is dividend cuts. Companies sometimes reduce or eliminate their dividends if they experience financial difficulties. That's why it's crucial to monitor the financial health of the companies you invest in, so you can avoid unexpected cuts that could impact your income. Lastly, keep in mind that dividends are typically taxed as income, which means you may have to pay taxes on the dividend income you receive. The tax rate depends on your tax bracket, so it's important to understand the tax implications of dividend payments in order to fully assess your potential return on investment. Dividend index funds are also a popular way to earn passive income by investing in a group of companies that regularly pay dividends. When you invest in these funds, you're not just betting on one company. Instead, you get exposure to a wide range of companies that all share the trait of paying dividends. This can be a great way to build a diversified portfolio while also earning consistent income. The beauty of dividend index funds is how low maintenance they are. You don't need to spend your time picking individual stocks or constantly checking on your investments. By choosing a fund that tracks a broad group of dividend-paying companies, you're already spreading out your risk. This means that if one company faces challenges, it's less likely to dramatically affect your overall returns. One of the biggest advantages of dividend index funds is the regular income stream they can provide. Many of the companies in these funds pay dividends on a quarterly basis, which means you can expect regular payouts. This steady stream of income can be a huge benefit for retirees who need to supplement their income or for anyone looking to add a passive income source to their financial plan. Some well-known examples of dividend index funds include the S&P Dividend ETF, which tracks the S&P High Yield Dividend Aristocrats Index. This index includes companies that have consistently increased their dividends for at least 20 years. Another popular choice is the iShares Select Dividend ETF, which focuses on U.S. companies with a strong track record of paying dividends. These funds can provide a great starting point for anyone interested in dividend investing. To maximize the benefits of dividend index funds, it's important to choose funds with a history of stable performance. Funds that have consistently paid dividends and grown over time are more likely to continue doing so, offering you a reliable income stream. Also, keep an eye on the fees. Some funds charge management fees, and while these are often small, they can add up over time. It's a good idea to select funds with reasonable costs to ensure you're keeping more of your returns. However, there are a few things to watch out for. Even though dividend index funds are generally considered low risk, no investment is entirely without risk. Companies can sometimes cut or suspend their dividends, especially during tough economic times. If a company you're invested in runs into financial trouble, it could stop paying dividends, affecting your income. It's important to be prepared for this possibility and not rely entirely on these payments. Additionally, while dividend index funds tend to be less volatile than individual stocks, they are still subject to market risk. A market downturn can affect the value of the fund, and short-term fluctuations are always a possibility. If you're in it for the long haul, it's important to be mentally prepared for these ups and downs. Finally, not all dividend funds are created equal. Some focus on high yields, meaning they prioritize paying out a lot of money in dividends. Others focus more on long-term stability or growth. Before choosing a fund, it's essential to understand its strategy and how it aligns with your financial goals. By doing so, you can ensure that your investment is working for you in the way you need it to. Another method is high-yield savings account, or HYSA. This is a special type of savings account that offers a higher interest rate than regular savings accounts. When you deposit money into an HYSA, the bank pays you interest, which means your savings grow over time. The best part is that it's a safe and reliable way to build your money while keeping it easily accessible. One of the biggest advantages of a high-yield savings account is that it provides risk-free income. These accounts are typically FDIC insured, which means your money is protected by the government up to a certain limit. That gives you peace of mind, knowing that even if something happens to the bank, your savings are safe. Another perk of a high-yield savings account is instant liquidity. This means you can access your money whenever you need it, whether it's for an emergency or just a planned purchase. There are no penalties for withdrawing your funds, although some accounts might limit the number of withdrawals you can make per month. This makes it a great option for emergency savings, offering both growth and flexibility. Popular examples of high-yield savings accounts include Ally Bank and Marcus by Goldman Sachs. Ally offers a competitive interest rate and doesn't charge monthly maintenance fees, making it a great choice for anyone looking to grow their savings safely. Marcus also offers high interest rates and no fees, giving you easy access to your savings with no strings attached. Both are great options to consider when you want a hassle-free way to earn more on your money. To get the most benefit from a high-yield savings account, it's important to compare interest rates across different banks. Rates can vary significantly, so taking the time to shop around can really pay off. Even small differences in interest rates can add up over time, helping your savings grow faster. Another smart tip is to set up automatic transfers to your high-yield savings account. This makes saving even easier because you don't have to remember to manually transfer money each month. By setting a specific amount to transfer automatically, you'll be saving consistently without thinking about it. It's a great way to build a savings habit and keep your account growing steadily. However, there are some precautions to be aware of. Some high-yield savings accounts have fees if your balance falls below a certain amount. Always check the terms and conditions before opening an account to make sure there are no unexpected fees that could eat into your savings. Interest rates can also fluctuate. While the rate might be high now, it's important to remember that these rates can change over time, usually depending on the economy. If the rate drops, your account might not be as competitive, so it's worth keeping an eye on the rates and considering moving your money if necessary. Lastly, many high-yield savings accounts limit the number of withdrawals you can make each month, typically to 6. If you need frequent access to your money, be mindful of these limits to avoid fees or restrictions. This is something to consider, especially if you plan to use the account for anything other than saving for emergencies. I-bonds are also a great way to earn passive income. I-bonds are a type of government bond designed to protect your money from inflation. Issued by the U.S. Treasury, these bonds offer an interest rate that adjusts with inflation. This means that as prices rise, the interest you earn on I-bonds increases too, helping you maintain your purchasing power even when things get more expensive. One of the biggest advantages of I-bonds is that they are considered a very safe investment. Since they are backed by the U.S. government, there's very little risk of losing your money. This makes them a reliable option for anyone looking to secure their savings without worrying about market fluctuations. Another great benefit is that I-bonds offer inflation protection. The interest rate on these bonds changes to reflect the current inflation rate, which helps ensure your investment grows at a rate that matches rising costs. During periods of high inflation, this can be especially valuable because your money will continue to grow even as prices climb. I-bonds also come with tax advantage. If you use the bonds for qualified education expenses, you can avoid paying federal taxes on the interest. This can be a huge benefit for students or parents saving for college, as it can make a significant difference in how much money they'll have available for tuition and other costs. The most common way to purchase I-bonds is through the U.S. Treasury website, where you can buy them in electronic form or as paper bonds. They are available for anyone to invest in, making them an accessible option for anyone looking to secure a safe and reliable form of passive income. To get the most out of your I-bonds, it's a good idea to invest during periods of high inflation. I-bonds perform best when inflation is rising because the interest rate adjusts accordingly. By purchasing them when inflation is on the rise, you can maximize your returns over time. It's also important to hold onto your I-bonds for at least 1 year. If you decide to cash them in before that, you may face penalties. For example, if you cash in your bonds before 5 years, you'll lose the last 3 months of interest. If you hold them longer, however, your investment can continue to grow. However, there are a few things to keep in mind. If you cash in your I-bonds before 5 years, you'll lose the last 3 months' worth of interest. So, it's important to plan for the long term when investing in them. Additionally, there are limits to how much you can invest. The maximum is $10,000 per person per year in electronic bonds and up to $5,000 in paper bonds if you use your tax refund. Lastly, while I-bonds are a great inflation hedge, the fixed rate portion of the bond, which is set when you purchase it, will stay the same for the life of the bond. If inflation decreases over time, your returns might not be as high as they were during periods of rising inflation. Credit card bonuses are a simple and effective way to earn passive income. By signing up for a new credit card or meeting a spending requirement within the first few months, you can earn rewards like cashback or travel points. Using your credit card for everyday expenses, such as groceries, gas, or bills, helps you reach these spending goals faster and easily. One of the biggest benefits of credit card bonuses is how quickly you can start earning rewards. You can accumulate points, miles, or cash back just by using your card for regular purchases. These rewards can add up fast, and they often come with exciting perks. Travel cards, for example, offer points that can be redeemed for flights, hotels, or car rental. Cashback cards let you earn a percentage of your spending back in cash, which can be used for future purchases or saved for a larger expense. Take the Chase Sapphire Preferred Card, for example. It's a travel rewards card that gives you points for every dollar you spend. New cardholders can earn a big bonus after meeting a spending requirement within the first few months, which can be redeemed for travel-related expenses like flights or hotel. Another great option is the CD Double Cash Card, which gives you 2% cash back on all purchases. 1% when you buy something, and another 1% when you pay your bill. It's a straightforward card that's perfect for earning passive income with minimal effort, giving you a steady stream of cash back on everyday purchases. To get the most out of credit card bonuses, try using your cards for purchases you were already planning to make. Whether it's for groceries, gas, or paying bills, putting those expenses on your credit card will help you meet the required spending amount without going over budget. Just remember to always pay off your credit card balance in full each month. Carrying a balance will rack up interest charges, which can quickly cancel out any rewards you earn. However, there are some precautions to keep in mind. Don't overspend just to hit the bonus. It's easy to get excited about earning rewards, but you should only use your credit card for things you'd normally buy, never for unnecessary purchases. Some cards also come with high interest rates, so if you don't pay off your balance each month, you could end up paying more in interest than the rewards you earn. Be sure to check the annual fees or foreign transaction fees of the card to make sure they don't outweigh the benefits of the rewards. Lastly, keep an eye on the expiration dates of your points or miles. If you don't use them within a certain time frame, they could expire, and you'll lose those rewards. By using your credit card wisely and strategically, you can turn everyday purchases into a valuable source of passive income, all while enjoying the benefits of cashback or travel rewards. Affiliate marketing is one of the easiest and most popular ways to earn passive. It involves promoting third-party products or services on your website, blog, or social media platform. Each time someone makes a purchase or signs up through your unique referral link, you earn a commission. The beauty of affiliate marketing is that it requires very little initial investment, and once you've set everything up, it can generate passive income with minimal ongoing effort. One of the key benefits of affiliate marketing is its flexibility. You can work from anywhere, whether it's from the comfort of your home or while traveling. Plus, you're in control of how much time and effort you want to put into it. As your business grows, you can scale up your efforts, adding more products and expanding to different platforms, all while working at your own pace. Another great advantage is that there's no need to handle inventory or shipping. Unlike running an e-commerce business, You don't have to worry about managing products or dealing with customer return. The product creation, storage, and delivery are all handled by the company whose products you're promoting. Once you set up your affiliate links, they can keep generating income over time without much additional effort on your part. This means that with the right strategy, affiliate marketing can provide a reliable source of passive income. Plus, the startup costs are minimal, especially if you already have an online presence. Popular affiliate programs include the Amazon Associates program, which gives you the chance to promote products across a wide range of categories, from electronics to home goods. If you're more into digital products, platforms like ClickBank offer higher than average commissions on ebooks, online courses, and software. ShareASale is another big network, connecting affiliates with brands in various industries like fashion, finance, and technology. And there's CJ Affiliate, formerly known as Commission Junction, which works with numerous advertisers across all kinds of niches. To make the most out of affiliate marketing, it's important to focus on a niche that has high demand. Choose products or services that people are actively looking for. For example, topics like fitness, technology, personal finance, or beauty products are always in demand. Building a strong online presence is also crucial. The more visible and trustworthy you are in your niche, the more likely you'll be able to convert your audience into buyers. You can do this by consistently creating valuable content through blogs, videos, or social media posts. Using multiple platforms to promote your affiliate products will also help you reach a larger audience. Don't just stick to one social media platform. Try blogs, YouTube, Instagram, or even email newsletters. Diversifying your promotional efforts will give you more chances to succeed. Another important tip is to optimize for conversions. Use clear calls to action, compelling product descriptions, and high-quality visuals to drive traffic to your affiliate links. The better your content, the more likely people will click on your links and make a purchase. Also, don't rely on just one affiliate program. Partnering with multiple programs will help you create a more stable and diversified income stream. However, there are a few things to keep in mind when you're getting started with affiliate marketing. First, avoid over-promoting products. If your audience feels like you're constantly pushing sales on them, they may tune you out. Instead, focus on providing value first, and then integrate affiliate promotions in a way that feels natural and helpful. Transparency is key. Always disclose your affiliate relationships to your audience. Not only is it required by law, but it also helps build trust. Your audience needs to know that you're recommending products because you truly believe in them, not just because you want to earn a commission. It's also important to understand the terms and conditions of the affiliate programs you join. Each program has different payout thresholds, commission rates, and rules. Be sure you know exactly how and when you'll get paid to avoid surprises. And finally, always keep an eye on how your affiliate links are performing. Use analytics to track which products or promotions are generating the most income and adjust your strategy accordingly. Since affiliate programs can change their commission rates or terms over time, staying updated on these changes will ensure you don't miss out on opportunities. Thanks for watching. Like and subscribe for more passive income ideas.